Namaste everyone. My name is Kushagar Sharma, and I'm the Vice President of the Canadian Hindu Chamber of Commerce. Today, I have the pleasure to be with all of you and introduce our first event of the CHCC Member Benefit Event Series. Today's talk is a talk on corporate strategies and tax efficiencies for your business by our guest speaker, Anil Chauhan. Anil ji is a very talented and very accomplished person. He has a $1 million roundtable, a designation as a certified executive advisor, a master financial advisor, and many other qualifications that he will tell us about. Before starting today's event, I want to quickly point out our disclaimer and just share with everyone that the disclaimer that we always share.
Disclaimer. Every effort has been made to offer current and accurate information to our attendees and members, but errors can occur. The Canadian Hindu Chamber of Commerce assumes no liability or responsibility for any errors or omissions in the content contained in this session. Furthermore, the information session may contain references to certain laws and regulations that may change over time and should be interpreted only in light of particular circumstances. This information is provided as is, with no guarantees of completeness, accuracy or timeliness, and without warranties of any kind, express or implied. The Canadian Hindu Chamber of Commerce does not warrant that any information, or other material, will be uninterrupted, error-free or omission-free. To the fullest extent permissible pursuant to applicable law, the Canadian Hindu Chamber of Commerce disclaims all warranties, express or implied, including but not limited to implied warranties of merchantability and fitness for a particular purpose. Thank you for joining us. Namaste.
Thank you so much. Before passing it on to Anil ji, I do want to point out that this year we have some new directors. I can see a lot of the new directors have joined us. I'm not gonna give everybody a chance to go through it. It'll take up a lot of time, but I will quickly give a shout out to each new director in our directors team for 2023-2024. So first, I want to give a shout out to Niresh Kumar Chavda ji. He is our president. I see Maharishi Jani is also here. He's our general secretary. I see Badri ji is here. He is our treasurer. And our other treasurer is Rashmikant Patel. He's not here, but I'll quickly go through our other directors who are also a very important part of our team. So we have Hitesh Parekh ji, Anand Iyer, Kavita ji, Aditya ji, Kaushik Patel, Meena Patel, Prashant Prabhakaran, Ajay Sharma, Vidya Varma, Tripati Vyas, Ganesh ji, Thiru ji, Kishori ji, Yashrat ji, Amit ji, Vipul Kumar ji, Dilip ji, Ranganath ji, I think Ranganath ji is also here, Vijal ji, Vijal Shah, Arvind Verma, Bhadresh Kumar Patel, Hardik Shah, Sanjay Batrirwala, Anand Kumar Tharmalingam, and Ritesh Sahu. So congratulations to all of our new directors who are all going to do something very big this year. And I want to thank each and every one of you who took time out to be here. And hopefully we can all get to learn something of value today. So thank you so much, everyone, for joining. And I would now like to pass it on to Anil ji. So thank you so much. And Anil ji, on to you.
Thank you very much. Good evening and namaskar to all the members of Canada Hindu Chamber of Commerce. I also would like to thank Naresh Chavda ji and Kushagar ji and all the other members involved in initiating this CHCC member benefit event series. Today I will be presenting a high level of corporate strategy and tax efficiencies for small businesses. Also, I shall be covering executives' roles and responsibilities and charities if we have some time on to that part. And at the end, definitely we'll be having some question and answer to go over. So let me start sharing my presentation. All right, let me see if I can slide these. All right, so corporate strategies and tax efficiencies. I'll go through one small disclaimer onto this, as we have gone through CHCC's disclaimer. I'm not an accountant or a lawyer or a real estate agent, or for that matter, mortgage agent. Any other information, advices in relation to all these fields mentioned should be consulted with your respective agent or advisor. So in this corporate strategy and tax efficiencies, we'll be looking into what are these and why they are there, and how we can take benefit out of all these strategies. I'll be focusing on a few of them. So basically, they are all related to, I could say, conceptualized onto the estate planning strategies. So overview of that, we'll go through this corporate investment strategy, corporate retirement strategy, and as I mentioned, we have some time, we'll go over executive roles and responsibilities, because at the end of the day, when we finish this, when we go through the estate planning, we want to know who will be the executor and who is going to take the ownership when the person testator is not there. So I'll touch base briefly onto that, and charity giving and what are their benefits. Definitely there are tax benefits onto it. I'll be discussing a little bit onto that. What are our advantages? So we provide support, service, and solutions by providing you with the access to estate and financial planning services, team of professionals who will assess your complex situations, work with other professionals, accountants, your accountants for you, recommended and implement customized solutions to you through tax-effective estate planning strategies. Now, what are our options? So option first, pay tax on interest, income, and capital gain. That's what we do. The second option is consider a financial planning strategy known as personal retirement account or personal retirement strategy, we can call it. Let me see if I can minimize this. Okay. All right. Why consider a tax-exempt strategy investment, personal or corporate? So this works on both. So that's why I put it both on this point. So the investments that we do, whether it may be equity, real estate, stocks, or we have fixed income, or we keep some cash. So these are the basic main things that what we do for the investment part, personal or corporate investments. There is we can diversify, add an asset class to what we do the investment for personal or corporate. So as I mentioned, we do equity, stocks, fixed income, GICs. We can add on, which is corporate investment strategy or personal retirement account or strategy. We can add on to that, and we'll see some benefits out of it. So the benefit of adding PAR as an asset class gives you three basic things. Tax sheltered investment growth. It gives you tax efficient income, as well as we were talking about estate planning, it gives you tax-free estate benefits also. Here I'm choosing this PAR, which is participating kind of in a whole life. So let me put a little point onto this, that PAR participating, basically, this is a tool that we use in the strategy for as an insurance. So, and the strategies are basically, they're not any product. So participating policies, when I talk about it, it is a strategy which we can put it in place into a corporation. to see the benefit. So PAR is an asset class, you can say like that. Why it makes sense, if you look at it, stocks, if you invest in stocks, bond, cash, if you keep cash and real estate, majority of the benefits that you're looking at it, you're getting it into this PAR whole life, which is one diversification that you can do into your investments, like predictable and a fair return that you can get. Tax efficiencies are there, market participation without market correlation, important aspect, history of paying dividend. So all these participating policies with big insurance companies, those who are there in market from 150 years or so, they have not stopped giving any dividends. So history of paying dividend is there. Loan privileges are there, guarantees are there, industry stability. So where they invest, these insurance companies are the stable industries. That's why they are giving the dividends. Low maintenance, estate advantages that you get, and credit protection. This is one important aspect that you see none of the investments gives except those participating or whole life if you have that investment in. So credit protection is there too. Things to consider, risk factors. So there are risks which we should consider. It's a mortality risk is there. Financial risk, as we are talking, the interest rates. So actual loan interest rates are little higher than the projected ones. Changes in business practice of lending institutions could be there. Policy owners may not qualify for loan. It could be many reasons onto that. So tax risk is there, which is Income Tax Act can change their rules, which we do not know and which we may not know at this point. Policyholder dividend risk are also there, and collateral assignment depends upon how much collateral additional they may ask, depending upon the individual or the corporation. So remember that you won't have to make a decision to leverage or withdraw fund from any for many years. Sorry, a renewed assessment of the risk can be made at that time. In the meantime, you have access to tax shelter investment growth, tax-free fund payable to your beneficiaries. What are these things? We'll discuss a little bit further on to other slides. So let us take a situation. So here the situation for one of our corporation, we're taking an example in general. Say you are a business owner and or incorporated professional. You have an operating or maybe in a holding company, OpCo or HoldCo. Retained earning or a surplus cash is invested in taxable investment. And you need access to funds for retirement, investment, or business. Maybe it's a cash flow that you're looking for business. Portion of investments earmarked for beneficiaries and or charity. So this is the scenario that we are taking. A typical corporation investment structure is like this. You have a corporation, you're paying salary and dividend to yourself. You have OpCo, which is active, and a HoldCo in a passive state where you have a corporate investment income tax. You have a tax on liquidation, and here's pay the tax at the end. Solution that what I'm suggesting here, corporate investment shelter, what is it? An effective estate planning strategy for business owners to minimize the tax paid on corporate investment income. So this is one major thing. And the second, minimize corporate values transferred to the shareholder family. These are all for the tax efficiency based that we are talking here. So solution for corporate investment shelter, which is corporate investment strategy, I may call it. As we discussed, we have company with paying salary dividend, OpCo active, HoldCo passive. It has all the corporate investment income tax, tax liquidation is to pay. When we embed another strategy up here, either we can transfer assets from our investment in corporation, or we can add another investment into corporate investment shelter. This will give us, it will maximize tax shelter growth. It will maximize tax efficient income. Also, it will maximize tax-free funds, which is estate planning, where you have a huge taxes at the deemed disposition. So all those taxes, you can maximize tax-free funds at this point, part of it. We'll discuss a little more onto this. How the corporate investment shelter works. So let's say this is a corporation which has an excess earning. Taxable investments are there in the corporation. Corporate tax on investment income, capital gain, liquid value to pay dividends, and then personal tax on top of it on dividends, that personal tax that you pay. And after that, whatever left is after tax value to heirs. Now, this is the strategy that we're talking embedded into your corporation. Corporate investment shelter is an excess earning that you put it into this. There is no corporate, there's no corporate tax on investment income and capital gains. This is the major part. And you get a cash value to fund retirement. So these are the two major aspects right there. Tax efficiencies and tax-free death benefit paid to corporation. So this tax-free death benefit, when it is paid to corporation, it flows through CDA. It goes through CDA and then it flows from CDA to heirs after tax value to heirs. So the two important aspects: investment income taxes, capital gains, they're not there. You get the cash value, as well as tax-free death benefit goes to CDA account. And from CDA account, it can be drilled down to your estate or to heirs. So we'll talk a little bit more on to the corporate retirement strategy. What are this? How it works? So there's a client. He makes an investment during the years into his personal or corporate, his or her personal or corporate retirement account. And then the collateral assigned policy at a future date, lending institutions, it goes to the lending institution, and lending institution advances a tax-free loan for or a line of credit to individual or corporation. At the death of the owner, personal or corporate retirement account, policy death benefit pays off outstanding loan to lending institution. This is at the death of the owner. So during the whole life, it does not get activated. So policy death benefit pays off outstanding loan to the lending institution, and this will include capital as well as the interest. And the remaining policy proceeds, because there is an accumulation there. So part of it goes to the lending institution, whatever is outstanding loan, and the remaining goes to the proceed to the beneficiaries. How it works, what is the mechanism of this? CRS may be structured in one or two ways: corporate borrowing or a shareholder borrowing. So as I mentioned before, the structure chosen at the time the loan is requested, not at time of insurance application. Tax consequences, it may vary with which structure that you use. And yeah, so let's see what corporate borrowing is. You have a corporation, we assign a life insurance into it. financial institution loans money, it will depend upon basically what collaterals that they will be looking. Again, it depends upon company to company and to their financial statements. So financial institutions loans money, it goes back to the corporation, pays income taxable dividend, and then from there it drills down to shareholder. So mechanism for the corporate borrowing is at death of shareholder, tax-free death benefit first pays of loan and interest as shown in the last slide. Death benefit proceed creates a credit to the capital dividend account. This is a very important aspect that you don't see in the individual thing. This is basically into the corporation. So death benefit proceed create a credit to the capital dividend account, CDA we call it, to the extent they exceed the policy adjusted cost base, CHCC. Amount equal to the CDA can be paid as a tax-free capital dividend to the shareholder estates. This is a huge benefit that you get when the death benefits are flown through the CDA account, and it's a tax-free capital dividend account to the shareholder estates. Excess can be paid as a taxable dividend. Now, the second option or the part is the shareholder borrowing. How it works: there's a corporation assign life insurance policy, financial institution loans money, it goes directly to shareholder. In corporate borrowing, it goes to corporation, but over here it goes to the shareholder. We must determine the structure of a loan payment at the time of application, because there is a guaranteed fees that has to go to the corporation, which is basically the difference of corporation charges onto the loan for the interest versus the individual would be charged onto the same loan. So the difference of that becomes a guarantee fee that goes to the corporation. So that can be discussed later at the point when it's in the process. CRS mechanics shareholder borrowing, how it works is to avoid a taxable shareholder benefit. The shareholder's estate should repay the loan balance as follows. So this goes in this way: estate pledges additional collateral, lender, which is the financial institution where you have kept that collateral, life insurance policy, lender releases that life insurance policy. Death benefit paid tax-free to corporation. Corporation pays dividend to estate using CDA. Estate pays off loan balance. Over here, there's one small point I would like to emphasize as I discuss that, as I mentioned that we'll be talking a little bit more onto the charity part. Just keep it in mind that estate pays off this loan balance, and estate gets this tax-free benefit. Death benefit goes to the point number 3. Death benefit pays tax-free to the corporation, and the remaining tax-free amount which stays there in the estate, it can be given to charity, and from charity you can get donor tax receipt to pay your estate taxes. So how it works, I'll let you know in later slides. So this was all about the corporate estate strategies that we're talking for the business owners and self-employed professionals. I have ran very fast onto this. It's a very high level. It depends upon corporation to corporation and their financial statements. There are many things that we go through with the financial planning and estate planning to see what options, whether it's a corporate borrowing, shareholder borrowings, will be feasible at that point. So yeah, so this is about this corporate strategies. Now I'll touch base a little bit onto what are the executor roles and responsibilities. Why I have embedded this few slides of executor here I felt it that after I'm going through most of the clients and listening to their situations, in general, what we do is we spend all of our time in business and family and accumulating wealth. At the end of the day, we, in general, it has to be drilled down. How to drill down? These are all in our mind. They are not jotted down. So how these things works, what are the challenges that testator, or if I call it an owner, say for testator or a owner wanted to ensure their estates are well prepared so as not to burden on their executors, CAs can play a better role into this, because transition of wealth from generation to generation, how it can cascade and how it has to drill down, it's a kind of a challenge where I haven't seen much of an effort has been made, or in my opinion, people are putting attention to. They should. And CAs actually, they are expert in their field, and they are equipped with the steering all those potential problems and helping out in a professional way. So that's what basically is. If you look at it, there are 17 fields or professions that executor has to touch. Now, executor do not know what they are and how to do the execution when testator or owner is not there, and they have assigned an executor. 99% of executors which are assigned are basically either a family member or a friend. It could be lawyers also, and there are many, but 99% are those family members, those who we trust. On the trust aspect, executor takes this role and responsibility, but this executor may not know all these 17 fields to touch, and how to and when to, and these are very important aspects. So example, executor has to know, should know, and in my opinion, owner as well as when they assign a executor, they should sit down and executor advisor should come in and explain what are the aspects of this. So they have to go through the type of property or ownership they have, the investment of the property they have, what will be the value of their property, if they have to liquidate certain investment properties, what would be that, and what are the digital properties. We don't take a look into that. So this is important aspect too, because nowadays we have a cloud where we put our data, which are more important. They're very expensive at certain point. It could be a Facebook, it could be your emails, all other digital accounts related. For that matter, say someone has a crypto account, or because now, as you know, that digital currency is coming in. All these are having a password which are very difficult, and I mean to say to go into the account. So only owner knows it. So if these are not drilled down or put in safe place at the time to be executed, and executor does not know, then all these things are lost. So digital properties, power of attorney. Now, executor do not know, as sometimes or most of the time, how many wills are there. There are will as well as how many POAs are there, finance, health POAs, and they are inversely proportional, I would say. Will is active, PO is not. When PO is active, will is not. So it's an eye-opening for an executive to go through all these things. Introduction to trust, call, and their taxes onto this, how many taxes that they have to, executor has to file once the owner is, testator is not there. Challenges of estate administration is a big thing, where executor has tremendous stress because he took the ownership of responsibility of managing the estate. Has to go through the counseling sometimes to mitigate those stress. It could be conflict resolutions, has to go through this, dealing with the beneficiaries. There could be a conflict with the beneficiaries, what is there in the will, what it should be there and what is not. So many challenges, financial challenges will be there. Probate, if probate kicks in, there is a fees before to pay, where the money will come. So challenges of the will there, insufficient assets are there. So all those sort of things are not in the mind of an executor when they look into this. So these are the things to be addressed. I'll close this this with the last slide onto this for executor role. Let me expand this. So estimated, these are some statistics I just wanted to share. Estimated Canadians without an updated will is 70%. When we say updated will 70%, every year, I mean to say year or after 2-3 years, is that one should look into their will, look at what are the, if there are any changes, it has to be amended onto this. Otherwise, they are not considered as a valid wills. Average number of Canadians turning 65 over the next 5 year per day is around 1,400. If you look at, then estimated transferring of asset when to the next generation in the next 20 years is $1.5 trillion Canadian. It's a huge amount in transition from one generation to another generation. Lot of opportunities are there to save taxes, and how to, and whom to talk. Those are the things that we should consider. Executive survey reports, this is for executors, what they say, administration complications. Different provinces have different forms to fill out and whom to go, where to go. Big challenge, 47%. Emotional issues, dealing with the beneficiaries as well as the family, 31%, and the legal issues, 26%. Percentage of 16.3 million Canadians aged 45 and over intend to appoint friend or family as their as 99% as an executor. As I mentioned it before, it's a huge thing to take into account. Executors have seen what happens when estates aren't properly prepared, and the fallout can be shocking. Estate can be frozen for years, sometimes decades. Heirs can be disinherited, intended charitable bequests can be defeated, and families can be permanently ripped apart. So I just wanted to add all those things so that we should at least look into those. Last not the least, charity giving. We do charities mostly, as we have statistics that most of the time we do charity with the cash. I've given one example comparing with what are the other options, like public shares with zero cost. One can donate matured public shares, flow through shares also, and the life insurance policy one can donate. They can put the beneficiary to their foundation or to the charity of their preference. So example donation, I've taken a 1 million, someone through the corporation or someone wants to donate personally certain amount. So example, 1 million after tax cost of donation. After tax cost of donation, it costs this much if you pay cash. And the cost of percentage is 49%, almost 50%. It costs you. If you donate public shares, it will cost percentage 22%. Flow through shares 14, and this is what you get. You pay 120. This is the after cost. It costs you 12%. So this is what it is. And majority of the time that we do this, to take advantage, one can consider all these other options also from the tax perspective. Math of a plan giving, I just wanted to put down some of the things which are helpful. Receipts, which is the donor tax receipts, can be used to offset 75% of net taxable income payable and can be carried forward up to 5 years. At death, receipts, which is the DTC, donor tax receipts, can be used to offset 100% of estate tax, including prior year. Very important aspect. So $2 donation results in $1 tax saving. Donations of appreciated securities, I have given this, where example of a client usually gives 50,000 in cash. Now client can gift 50,000 in shares. Cost base, which is when he bought it, it was 10,000 capital gain. I mean to say it appreciated 40,000. No capital gain tax upon donation. Very important thing. No capital gain tax upon donation. Tax saving is this much. Full tax receipt for 50,000, which is a tax donor receipt for 50,000. One can park their dollar in DTF, which is donor advisor fund. So if someone don't know which charity or foundation to pay this before taxes, so what they can do is they can park in donor advisor fund, and then later on they can say this much of amount can go to this charity or a foundation, because the moment they put it into this DAF, they can get tax deduction, donor tax receipt for that particular amount of that, the amount that they have put in DAF. So just point to make onto this. Now convert taxes into charity. This is for corporation. I've just put some high level thing. A corporation owes 50 million of tax. Corporation purchases, this is an option given. Corporation purchases 1.3 million premium policy per year for 10 years. So in total 10 years, they pay 13 million in a premium for a policy of a $50 million. 50 million death benefit at the end, 50 million death benefit paid out tax-free through CDA upon death, as we discussed in corporate strategies. Estate makes 50 million donation to foundation. So when estate gets the death benefit, makes 15 million donation to foundation, estate receives 50 million of tax credited death. 100% of taxes are now turned to charity, creates 50 million of charity. In total cost, it costs 13 million. Charity gets 50 million, and your taxes for the estates are also paid. Government gets 0. Real estate also is the same scenario. I think we're running out of time, but definitely I'll be talking more onto the detail. I'll reach to this last, not the least. CPP pension is taxable, as we all, example, 26,000 for a couple of not needed for retirement. Use the amount to donate to foundation. Tax credit receives will eliminate tax on the CPP benefit foundation or users fund to buy. Kushkaji, is it okay? I was seeing that there was some internet connection thing. Is all right?
Yeah, it's on my end. You can continue.
Oh, okay. All right. So anyway, this is the last slide, as I mentioned. So tax credit received will eliminate taxes on the CPP benefit. So this tax credit on tax CPP benefit, it eliminates foundation. Charity uses fund to buy this much life insurance policy on death, this much of a amount, 1.4 million received by foundation with no tax on CPP. Now donate this 1.4 million to charity upon death to save estate tax of 100,000. So say estate has, so these are all basically plan based. I have given just the numbers here. So if estate as at the end to pay 700,000, so on that you can drill down to this much numbers we came out. So CPP is also taken into consideration. Leave 1.4 million to children and need this again. There's another option. You can do RRSP if you don't need it. There is a tax on it when you withdraw, or refs, and give it to charity. Leave 1.4 million to grandchildren pension plan, and then they can proceed this donation by them each year to charity for tax saving for their tax years to come. This slide, I know I ran a little fast, and because of the time constraint, definitely I was discussing with Kushaji that these presentations need some time, and if we do it into the presentation, I mean, this is a one-on-one or in presence in some of our conference places. At that point, it's more easy to explain. But anyhow, I hope you understood it. If you have any questions, you can ask me. I have this slide where you can, I would request Kushagarji, this link, if we can post it into a chat or to the email. So if somebody wants to make an appointment one-on-one, we can do that. And we'll see if we can help in giving some corporate strategies and tax efficiencies for their corporation businesses. Thank you very much for listening. Any questions? I'm ready to take some questions. And if their time does not, if there's not much of a time, then we can, I can ask Kushagarji to email it to me, and I will reply back to those questions. Over to you, Kushagarji.
Thank you so much, Anilji. So if anybody has any questions, please raise your hand. I know a couple of you did message me as well. If anybody has any questions, you can put it in the Q&A. Someone put a private message to me. How can businesses ensure that they are in compliance with Canadian tax laws while also maximizing their tax efficiency?
These are all the strategies that we do. It is not today's thing, or we started on it on our own. No, these strategies were all in place, all in there. They're all enhanced to in Tax Act. And as I mentioned before also, there are certain risks as Income Tax Act can change their policies, but it would not be that it's only for that individual. It will be for whole. So it could, if it impacts, it will impact to all those which are in place or coming in to those, because at that point then strategy can be changed or amended. So it is possible that tax Income Tax Act can change, but those who are in place, they are in there, and it's not from today. It is there from years and years. I can give you one example. During Depression era, they had an issue at that point where he wanted to give for his planned manufacturing unit, he wanted to could afford to give salaries, so he used cash value of his policies that he had, and those that he used it to pay the salaries to his point, so to survive basically. So yeah, these things are already in place from many years, so it's not new. I answered your question.
Perfect. I can see Snehal Pandyaji has his hand up. I will allow him to ask his question.
Jay.
Snehalji, you can go ahead.
Yeah, namaste. Can you hear me?
Namaste. Yes, I can.
Okay. My question is for the owner of the corporation, what's the right age when you start this planning? I mean, are there any thumb rules that you start your estate planning from a specific age, or it doesn't really matter when you are ready to wind down your corporation? That's when you start the estate planning.
Snehal-ji, it's a very good question. Thank you for it. Actually, I have touch-based only 2 of those strategies. There are many, so it's not that if you age matters, no doubt age matters. I can give you a sweet spot from, say, somebody has started from age 30 onward to 50, 55, 60, they can, even we can do, as I mentioned, that we can do the retirement planning at the age of 60s plus, so that, again, all these things, age does not matter. I would say it matters to a point that if someone is drilling down or going through a succession planning where they want to either close the corporation or a business, or they want to transfer it to their shareholders or to the family, or they want to just sell it. So any 3 options of that stage, we can also come in to help. How to do this, how to make the value of your company more valuable at the time of succession planning, to do the succession planning at this point. So answering to your question, age kind of does not matter at this point. We definitely look into the financials though. So we look back into the stability of the company, because these things does not only go through us. We have to involve your accountants, lawyers, your lawyer at this point. So to make sure that things are all in place and then these strategies can be implemented. So again, depends upon company to company, their financials, their situations, and which stage they are, the early stage, mid stage, or succession planning. But yes, we can do all. Hope I answered you, Snehal-ji.
Yes, thank you.
Thank you so much, Snehal-ji. I see we have 2 questions. We have one from Monty-ji. How to save tax on capital gain? I have invested in stocks and I have used a personal account. So the question is, how can you save on capital gains when you've made investments in stocks?
Okay, so as I was touching base on one of a slide where I was talking about it in charity. So that's a very good benefit. I mean, to the point that we can do. So in a charity, uh, say example, they have a public share. This public share, they bought it at say $10,000 and kept it, and it got the growth on it is up to 50,000. So if they sell it on 40,000, they will have a capital gain tax. Over here, when they do a charity, at this point, the capital gain, there is no tax on the capital gain. So you can eliminate the capital gain. In addition, not onto the ECB, but onto your actual share value, which is 50,000 example. You get DTC, which is a donor tax credit to mitigate your current taxes at this point. Two things that you can do. And the third, not the last, is that you are making your donation. So three things that you can do. Yeah, charity can help answering to your question.
Thank you so much, Montiji, for that question. Our next question is from Badriji. What would be minimum business annual income and or personal income that you or your firm provide services for?
Good question. It's not my corporation will do. It's kind of a corporation which has a retained earning of minimum of 50,000 or more. Small businesses, we look into those which are basically goes up to 35 to 40 million retained earning. So yeah, minimum I would say they should have 50 to 100,000 retained earning. We can take into that.
Thank you so much, Badriji, for that question. We have another question. What are some emerging trends in corporate tax strategies in Canada, and how can businesses stay ahead of this change?
Emerging funds, I would, so first of all, these strategies that I'm talking about are not for the emerging funds, because I don't do any funds like equities or the stocks. So I cannot give any advice onto that aspects. Sorry for that.
We have another follow-up from Badriji. He's asking about what would be the minimum personal income for a salaried individual that your firm would provide services for.
Okay, so so it should be minimum. I would say we say minimum 50, but it should be more than that. If somebody is withdrawing salary of say 50,000 and from the corporation, and say dividend of say 25%, 25,000. So yes, we can work from there, but it is very barely minimum at this point. So if someone has 100,000 withdrawing and the dividend comes up a little bit more onto those, we can work with them. Hope I answered, Montaji.
Thank you so much, Badriji. Do we have any more questions? So if you have a question or you think of something later down the road, please feel free to contact Anilji. If you don't have Anilji's contact, you can please contact us and we will gladly refer you to Anilji so you can get the expert advice that you need. I really want to thank everyone for joining today. Just a reminder and a thank you to all the people that have joined. I know a lot of you people aren't CHCC members. So for those that aren't CHCC members, we thank you as well. And for our members, you know, you guys are our backbone. You guys are the backbone of this organization and the reason why we're able to bring events like these. And to all the people that aren't members, we really hope that you become a member and become a part of this organization so we can all work to bring more events like these and bring more benefits to the community and have more knowledge that's passed on to one another. So thank you so much. If you are interested in CHCC, you want to learn more about the organization, please feel free to email us at info@chcconline.ca, info@chcconline.ca, and we will gladly give you any information about the organization, steps on how you can become a member, and how you can become more actively involved. This is the first event of our CHCC membership event series. We will bring many more of events like these to all the members to give them different types of benefits from different individuals and different corporations that exist in Canada. So please stay connected with us. Please watch those emails. Please watch our social media. If you don't follow us on social media, please follow CHCC on Facebook, Twitter, Instagram, whatever social media you follow, please make sure you do click that follow button so that way you can stay connected and learn more about events such as the one today. We really hope everybody learned something of value today. And like all of our CHCC events, this one will also be available on YouTube. So you can, if you want to remember something later on, you think you learned something really important, you can always go back to our CHCC channel on YouTube, go back to the videos and view it again. It will all be there. So I really want to thank everyone, and our next event will be announced very soon. We have one at the end of this month, and we're going to try and bring something every 2 weeks, 2 to 3 weeks for you. So please stay connected with us, and we really hope for everyone to join us again. Thank you so much, everyone, and wish everybody a very good night. And thank you to everyone joining us from all across Canada.
Yeah. Thank you very much to everyone for listening. Thank you. Good night.